Hey guys, in this video we're going to talk about the different types of life insurance. Primarily we're going to talk about indexed universal life. So in this video we're going to talk about what it is, how it works, the pros, the cons, all of it. So by the end of the video you'll fully understand exactly what it is. Let's go ahead and jump in. So there's two types of life insurance. The first is a temporary or term life insurance policy. What this means is that it's going to expire usually within 10 to 30 years from whenever you get it. Think of it like renting a house. So you don't own the house, you rent the house. However long your lease is, that's how long you have to stay there. And the premium payments that you pay are just all going toward the rent. The second type is called a permanent life insurance policy. Permanent life insurance policies last your entire life, so they don't expire like a term. So it doesn't matter if it's 10, 20, 50 years from now. If you pass, then that policy is going to pay out. And they also have what's called a cash value component, which we're going to talk a little bit more about later. And there's a couple of different types of permanent life insurance policies. And we're going to focus on the indexed universal life insurance policy in this video. So let's talk about how indexed universal life policies, or IULs, work. There's going to be what's called a premium payment that you pay either monthly, semi-annually, or annually, just depending on how you want to do that and what works best for you. And that premium payment goes toward two things. One is the cost of the insurance, because these are life insurance policies. So since it's a permanent life insurance policy, it's whenever you pass, not if you pass, that's going to be paid out completely tax-free to your beneficiary. Part of your premium payment goes to paying that, and then the rest of your premium payment goes to what's called the cash value of the policy. This is kind of like your equity in the policy. This is the cash value that you can use. It's going to grow. And whenever it grows in relation to the stock market. Primarily, the most common is the S&P 500. The goal of the IUL's cash value is to capture market appreciation, but have no downside risk. And we're going to talk a little bit about what that means here in a second. Now, there are two different cash value accounts inside of an indexed universal life policy. One is called the general account, and it essentially has a fixed rate of interest that you're going to earn on any money that's inside of your general account. So that could be, let's say, 3%. The second is called the index account, and the money that's in that account is growing in accordance with the stock market. So if the stock market goes up, then your cash value will increase, and with the downside protection, if the stock market goes down, then you don't lose any money. And different companies, different carriers give access to different stock market indexes. The most commonly used is the S&P 500. Let's go ahead and look at some examples of what would happen in different scenarios of the stock market. So indexed universal life policies usually have a cap, and a common cap is around 10% at the time of recording this video. So let's assume that you have a 10% cap and the stock market increases 5%. So your increase in cash value in your index account would be 5%. Now let's say that the stock market increased 10%. Your increase in your index account would be 10%. And in the last scenario, let's say the stock market increased 15%. So since you have that cap of 10, it would be an increase of 10%. And now you might be wondering, why would I want a cap? Well, the cap is a small price to pay because of the downside protection. It's called a 0% floor, and it's essentially a way for you to not lose money because of stock market downturns. So let's look at a couple of other scenarios and see what would happen if the stock market stayed flat or decreased. So let's say that the stock market just didn't do anything that year and it increased 0%. So it just started and ended the same. The increase in your index account would be 0%. Now let's say another scenario is the stock market decreases 10%. So it goes down 10%. Your index account would stay at 0% because you're protected from those market losses. So right now you might be asking yourself, well, how is that even possible? How are the insurance companies doing this? It seems too good to be true that I can take advantage of the upside of the market without having to take the losses of the downside. So let's talk about how the insurance companies actually do this to where you can capture market appreciation without any of the downside. All right, so remember we have two accounts, right? We have the general account that pays the fixed rate of return. Usually, let's say in this case it's 3%. And then we have the index account, which participates in the stock market indexes. If you had $100,000 in the general account, then you'd be earning 3% on that. And if you had the $100,000 in the index account, what they do is they take that 3% and they invest in what's called options contract. What is an options contract? Well, the definition is an agreement between two parties to facilitate a potential transaction involving an asset at a preset price and date. But what does that mean? Basically, it's a contract that locks in a certain price to either buy or sell at a future date. So the best way to understand this is an example. So let's say there's a house. The house costs $400,000 and you're interested in buying that house. But you're not sure where the market's going to go. Is the market going to go up? Is the market going to go down? Because if you bought the house at 400 and the market went down, then you'd be in a tough spot. But if you bought the house at 400,000 and the market went up, you'd be in a great spot. But the market is really volatile right now. You're not really sure where it's going to go. So what do? What you can do is you can buy an option to purchase that house at a future date at the $400,000. So the seller with the house would sign a contract with you, giving you the right to buy, let's say 12 months from now, that house at $400,000, no matter what the market conditions are. In return for the seller giving you this contract, let's say you give the seller $5,000. So you're $5,000 to have a contract that gives you the option to buy the house at $400,000 at a later date. Now let's fast forward to 12 months from now. And let's say that house is worth $450,000 now. Okay, so you have a contract that lets you buy it for $400,000. It's worth $450,000. So of course you're going to exercise that option. It's what they call in the stock market in the money. That means you have paid $5,000 for the contract. You exercise your option to buy, and then you buy the house for $400,000. So you're all in the deal for $405,000. And you've immediately made a profit of $45,000. Now let's look at a different scenario. Let's say 12 months from now, that house is only worth $350,000. So you have this contract that gives you the option to buy the house at $400,000. And of course, you're not going to exercise that contract because now the house is worth $350,000. You would let the contract expire because it's what they call out of the money. And you essentially would not have, if you would have bought that house at $400,000 before, and 12 months later it went to $350,000, you'd be negative $50,000. But since you purchased the options contract for $5,000 and then just chose not to exercise it, then you essentially did not lose any money other than the $5,000 you paid for the options due to the market downturn. So that's essentially what they do in the index account to allow you to capture the upside of the market without having to get any of the losses of the downside. So your index account, let's say it's earning 3%, they use the 3% to buy options if the options are in the money. So meaning if the stock market went up and they're profitable, they exercise those options. And if the options are out of the money, which means that they're not profitable, then they let them expire, which that's why a lot of IUL policies have that 0% floor, meaning that your money won't go down because of the stock market going down. Now with IULs, not every IUL is created equal. It's all based off of how it is structured and your goals. Different carriers can do different things. It's very important that based off of your goals and your needs that your IUL is structured accordingly. Now there's two main ways to structure an IUL policy. One is death benefit focused and the other is cash value focused. Now if it's death benefit focused, you want to try to get the highest amount of death benefit, meaning that when you die, that it's going to pay out the most amount of money tax-free to your beneficiary, and you want to try to get that at the most affordable rate that you can. And if you're wanting to make sure you have permanent coverage for the rest of your life, then obviously term would not fit that need. So your agent will show you what's called an illustration, and it's going to show you future projections of cash value and death benefit year by year based off of estimations. And there's going to be a few different columns that we'll talk about here in a second. But you always want to make sure that you see this illustration, your agent goes over it with you and explains everything to you. So let's talk about the three columns that you want to look at whenever you're looking at your illustration. So the first is going to be what's called the guaranteed column. The guaranteed column is the worst case scenario. That's everything's going to crap, companies going out of business. Those are your guaranteed numbers. Now, most of the carriers that we use have been in business for decades, if not over 100 years. So the likelihood of that happening are usually pretty low, but it's always very important to make sure that you know what you're guaranteed whenever you're going into this. The middle column shows you the fixed rate of return. So you'll see what it looks like if you were to just get a fixed rate of return of, let's say, 2.5%, 3%, whatever that number is. You'll be able to see that in the middle column. And then on the far right in that column, you'll see calculations based off of a conservative example of stock market returns. Sometimes that'll be 5 to 6%, 6.5%. If you look historically over the last 10 years of the stock market, it's returned an average of 11%, give or take, a year. So that's where they get the conservative estimates from. They're not showing you, hopefully not, 11% return a year, but usually it's like 6, give or take a little bit. It's also important to know that your cash value is going to look different most likely than what is on that conservative estimate, because you have to take into account years that the stock market performs better and years that the stock market performs worse. So keep that in mind. Now let's talk about a policy that is more cash value focused, which is one of the more popular options when getting an IUL. If you want your policy to be more cash value focused, you want your death benefit to be as low as possible. The reason you want your death benefit to be as low as possible is that's what's going to decrease your cost of insurance. Remember earlier we talked about every premium that you pay, it goes to two things. One is the cost of insurance, the rest goes to cash value. The lower we can make the cost of insurance by lowering the death benefit, the more money goes to the cash value, which can then be added to the index account, which then can grow with the stock market more. It is so important, if you want your policy designed for cash value, that you use an agent that knows how to do it. Make sure that they know how to lower the death benefit as much as possible and give you as much cash value into your index account as possible. So there's two main ways that you can access your cash in your cash value account. One is via withdrawals, and then the second is policy loans against your cash value. Now withdrawals, essentially how it sounds, you withdraw money from the account. That's going to lower your cash value, and remember, anything above the cost basis of what you've put in, basically anything above what you've put in to the policy, is going to be taxed via income tax. So this is the least used option because of the tax liability. Now the most popular way is the second way, and that's taking a policy loan against your cash value. Essentially, the money does not come from your accounts, it comes from the insurance companies, and they use your cash value as collateral. This allows you to use your money, and it's a loophole that the insurance companies use as well to allow you to use your money completely tax-free, because it's considered a loan, and it allows you to use your money and also keep it growing at the same time, which allows you to take advantage of uninterrupted compounding growth. Another reason that this is one of the most commonly used ways to access the cash value is because there's no payback schedule. So the insurance company does not lock you into a certain amount that you have to make every month or when you have to start. You can pay it back on your own time whenever you want. Just keep in mind there's a small interest rate attached to the loan. So the longer that the loan stays outstanding, then the interest will start piling up. And then any outstanding loans at the time of your death will be taken out of the death benefit of the policy. This also allows you to leverage your cash value to create a spread on your money. So for example, if your cash value is earning an average of 6% a year, and then you can borrow at 4%, then you're gonna make 2% spread on that money. And what a lot of people don't think about is if you're paying your loan back at regular intervals, you actually make more than 2%, because in this scenario, you're earning 6% on an increasing balance, and then you're paying 4% on a decreasing balance. So your spread would actually be bigger. Now there's two types of loans. One is a fixed loan, and that moves your money from the index account to the general account. And the loans on these are usually a lot lower interest rate that the insurance company charges. It also takes away from the index account and puts your money into the general account, which, like we talked about before, would lower the participation rate of your money in the stock market. And the second type of loan is what's called an alternate loan, and this is taken against money that's in the index account. So you still get participation in the stock market with that money. The interest rate that you'll pay the insurance company is a little bit higher on that, but the interest rate is still going to be lower. Most of the time, most carriers make their interest rates lower than what the prime rate in the market is. Let's say the prime rate is 8%, you might end up paying 4.5 to 5% on that, and maybe like 3% on the other. Now, don't quote me on those numbers because obviously each carrier is different, each market is different, but just to give you an idea. Also, a lot of times you can switch loan types each 12 months on the anniversary of the loan. So you're not stuck most of the time, depending on the carrier. Most carriers don't make you stay in that loan type. On the anniversary of that loan, you can switch the type of loan that you have. Now, the loans are based off of the surrender value and not the cash value. So early on, for the first 10 years, your surrender value will be less than your cash value. So your cash value is what's growing, how much you have in the cash value account, and what's growing with the stock market. And then the surrender value is how much you can borrow against and withdraw if you wanted to. And depending on how your policy is structured, you might be able to take out a loan as soon as 1 month, just depending on the surrender value. So the sooner you have a surrender value, the sooner that you can start taking out loans against your policies. Again, based off your goals and needs, make sure you talk to your agent. A question that we commonly get is, does age matter? And you can get an IUL from most carriers all the way up to age 80, and then sometimes even more. It really just all comes down to the underwriting, the health, criminal history, stuff like that. And another common question is, what happens to the cash value whenever you die? Because it's a common misconception that you lose the cash value. Now, you can lose the cash value, but you can also have it added to the death benefit. It's an extra fee in the IUL, but overall, it ends up being more paid out because you can have the cash value and the death benefit all paid out. IULs are one of the most customizable policies that there are, so it's very important that you know your goals and your needs, and you have an agent that knows how to do them. So depending on your goals and needs, you might want your cash value to be added to the death benefit, you might not, so make sure you talk with your agent about that. So what are the downsides of an IUL? So the first downside is, if you're just looking for life coverage and you don't care if it's permanent, you just want temporary life coverage at a super cheap rate, then term, although it's harder to get qualified for, it's going to be cheaper. It's also going to expire, so whenever it expires, you're going to end up having to, if you want life insurance again, it's going to cost a lot of times 10 times or more the regular amount. So right now, an IUL may cost more than term, but over the long run, term, if you want to continue to have life insurance, would cost more than the IUL. The second downside is, in the index account, if the stock market doesn't perform, then your account doesn't grow. So if the stock market stays flat or goes -20, -50, then you're setting at a 0% return, which is a downside. But if your alternative is putting the money in the stock market and absorbing those losses yourself and absorbing the 20 or 30, 40, 50%, hopefully it doesn't go down 50%. If the alternative is absorbing that yourself, then you could consider it, an upside, but it's still a downside to consider. And then the other downside is the growth can be unpredictable. So you want to be conservative in your expectations because you don't want hitting that massive growth to be a necessity. You want it to be a pleasant surprise. So be conservative in your estimate, because obviously the stock market can be kind of volatile. Over the long term, it increases, but the growth can be unpredictable as with any investment. And then the fourth downside, and really this is just depending on how it's structured and your goals and needs, but the fourth downside can be if it's structured just completely the wrong way, then you have access to just no cash value for a very long time. And if cash value access and growth is your goal, then obviously you would want to have access to your cash value sooner. So make sure that if that is your goal, now if death benefit is your goal, then that's a different story. But if cash value is your goal, make sure that it's designed for that. That's really a downside with the IULs, is that there's a lot of people, a lot of agents out there that are selling them, and there's a large number of those agents that don't know how to design them correctly, or maybe they only have access to 1 or 2 carriers that have IULs, so they're restricted on what they can do. That's why it's usually best to go with a broker that is licensed with multiple carriers so that they can get you, based off of your goals and needs, the best IUL design for you. And if you don't have an agent yet, we'd love to help you. A little shameless plug, but we'd love to help you. Go ahead and reach out to us. But we hope this video was helpful for you, and let us know if you have any questions or comments down in the comments below, and we will hopefully talk to you later.